Hello, everybody. So today we will be discussing closing procedures. So we will be talking about how to wrap up the accounting process with the final steps that we need to undertake in closing the book of accounts and to make it ready for the next accounting period. So before anything else, please continue using Handout 012, our example problem, which is landing on you, travel services company. So we will continue using that, and we are about to finish that handout for the whole accounting process, except for the last lesson about the accounting process, which is reversing entries, in the next video. Okay, so please continue using Handout 012, and I hope that you were able to understand the accounting process through the use of a very extensive problem in which we use that problem from the start until the end. Okay, so let's start. Wrapping up the accounting process includes 3 steps, which is we journalize and post adjusting entries, and then we also journalize and post closing entries, and we prepare a post closing trial balance. So we will be discussing them one by one. Okay, so first one is journalize and post adjusting entries. Adjusting entries were already prepared, and its effects were included in the worksheet and ultimately in the financial statements. However, these adjusting entries are not yet journalized and posted formally in the book of accounts. So if you would remember, we did a summary of all of the adjusting entries, and we did all of those analysis, and we did all of those adjusting entries. But the thing is, what we only did is we put them in the worksheet. And then after we put them in the worksheet, we use those effects, which is ultimately the adjusted trial balance. And the adjusted trial balance has been used in order for us to prepare financial statements. But those adjusting entries are not yet journalized in the general ledger, and they are also not yet posted in the ledger. So the thing is, those adjusting entries are not yet in the journal, and those adjusting entries are literally not yet in the ledger. So as far as the ledger is concerned, it's not yet adjusted. So what we need to do is a thing like this. Okay, so in your general journal, you just need to write the words adjusting entries and then simply do the journalizing of these adjusting entries. The adjusting entries that we did in our lesson on adjusting entries will just be the same adjusting entries that you will be putting in your general journal. And don't forget to have them posted. That's why if you will be looking on the posting reference column, you will see that the account numbers are already given there. That means that those amounts have already been posted. So remember, we just summarized the adjusting entries and we put them in the worksheet for us to be able to do the financial statements. But it's not yet in the journal, it's not yet in the ledger, so we have to put them in the journal, we have to put them in the ledger as well. Okay, so these are just the same adjusting entries that we have talked about, and the only thing that you need to do is to formally put it in the general journal and post it in the general ledger. After these adjusting entries are journalized and posted formally, the updated balances in the ledger should be equal to the adjusted trial balance column of the worksheet. So what do you mean by that? Remember that after you have journalized these adjusting entries formally in the journal, you will be posting them in the ledger. Now, after you have posted these adjusting entries in the ledger, basically what you will do is you will make again an update, and those updates are what you do, like you will do another ruling and balancing of accounts. So the amounts or the updated balances in your ledger should be equal to the adjusted trial balance column of the worksheet. Okay, so if you would remember, this is your worksheet and that is your adjusted trial balance column. So what we need to achieve is that when you look, for example, when you look at the T account related to unearned international travel fees, when you look at your ledger, you will see that it has 0 balance because your adjusted trial balance tells you that it has no balance anymore. And also, if you will be looking into your T account of accumulated depreciation on automobile, you will see in your ledger that you already have posted 25,000 pesos worth of accumulated depreciation for your automobile. The thing that we need to achieve is that after you have posted all of your adjusting entries formally in the general ledger, your general ledger should be equal to the balances that was in your adjusted trial balance. Only then you can say that your ledger is adjusted with the effects of the adjusting entries. Okay? So I hope that you get my point on that. If you have any questions, please comment them down below. Okay? Let's continue. So after your ledger has been adjusted by these adjusting entries, the next thing that you need to do is to journalize and post closing entries. Closing entries are entries that close the balances of drawing revenue and expense accounts to zero to prepare them for the next accounting period. In accounting, the drawing of this accounting period will not be the same amount of drawing next year. And the revenue for this accounting period will not affect the revenue for next accounting period. So what we mean to say is that the revenue for this year is only for this year. The revenue for this specific accounting period is only for this specific accounting period. The revenue for the next year is the revenue for the next year, and the expenses for next accounting period will be the expenses for the next period. It does not affect each other. Okay, so we need to understand that assets, liabilities, and capital are real accounts, and that drawing revenue and expenses are nominal accounts. So real accounts are those accounts in which their balances continue. Okay, it's cumulative. Like for example, if you have cash of 1 million in the previous accounting period, that would be brought to the next accounting period since you still have cash of 1 million. However, your revenue of 50,000 in the previous accounting period should be brought back to zero because you need to record a new set of revenue in the next accounting period. That's why our drawing revenue and expense accounts are brought back to zero. And those accounts that are brought back to zero to prepare them for the next accounting period is what we call nominal accounts. Okay, so the steps in preparing closing entries will be like this. Number 1, debit all revenue accounts and credit the total to the profit or loss summary account. Remember that revenue has a normal balance of credit. So in order for us to make it zero, we will make a reversal of it. So revenues are normally credited, so in closing entries, revenues are debited. And then we will be using a temporary valuation account, which is the profit or loss summary account. You can also call that account as income summary if you want to make it easier, okay? And then step 2, credit all expense accounts and debit the total of all those expenses in the profit or loss summary account. So expenses are normally debited, so in order for you to make them zero, you do another reversal. So expenses will be credited and then the total expenses will be debited to the same valuation account, which is the profit or loss summary account. And then, as you can see in the profit or loss summary account, since that is a temporary valuation account, so you have there the summarized amount of your revenue and expenses, and in which, as you know, revenue minus expenses is net income. So the net effect of the profit or loss summary account will be close to the capital account. So we will be bringing your net income or net loss effect to your capital account. And then, step 4, any balance of the drawing account will be charged against the capital account. So anything or any drawing or withdrawals, personal withdrawals that the owner did, it will also be charged to the capital account. Remember, that's how we do it in the statement of changes in equity in your financial statements. So we will be doing also in the ledger. We will be doing also it in the ledger. Okay, so here's how we do it. So also in your general journal, you write the words closing entries. The first step that we do is we close revenues. So this will be your closing entry for revenues as far as landing on your travel services company is concerned. Okay, so debit local travel fees earned of 73,160 and debit international travel fees earned of 832,440. Where did we get those amounts? Remember, before closing entries, we have already posted all of our adjusting entries, so we are sure that the ledger is adjusted before we have closed everything. Okay, and then we credit profit and loss summary account of 905,600. 905,600, if you would remember, and if you want to check, you go back to your income statement. That is your total revenue. Okay, so as you can see, the revenue accounts are being debited so that you will get a reverse effect because revenues are normally credited. Okay, the next step is we close expenses. So what you do is you debit profit or loss summary with the total amount of expenses, and then one by one you list all of the expenses in your ledger and you put all of those updated balances, but this time you put them in credit. Okay, because again, expenses are normally debited, so at this time, because we're doing closing entries, you will credit them so that it will go back to zero. Okay, and then we will be putting the effect of your net income or net loss in your capital account. So in our case, our problem is a net income situation. So you debit profit or loss summary with the net income amount of 336,100, and then you credit the capital account of 336,100 with the amount of net income, so that the capital account of the owner will be adjusted based on the amount of net income that he or she got that time. Okay, and then lastly, any personal withdrawal that the owner did will be charged against the capital account. So debit the capital account and then you credit the drawing account. And as you can see, since the drawing account has been credited already, so actually drawing is normally debited. So in that case, since the drawing amount that we did of 30,000 or the owner did is 30,000, since it was already credited, so the drawing account will also be or will also have an amount of zero. So that's how you do closing entries. Okay, so if we examine further, this will how your profit or loss summary T account would look like. The debit balance there of 905,600 is your revenue. And then the 569,500 will be your expense. And then the net effect of those two is 336,100, which was your net income. After the closing procedures, your profit or loss summary will also go back to zero. Okay? Because after all, profit or loss summary is only a temporary valuation account. It does not really do something in the financial statements. So after the closing procedures, your PL summary would also be zero. Okay, so after we have done journalizing and posting all of our closing entries, make sure that this will happen. If you look back to your ledger, your assets and liabilities should maintain their updated balances. And remember, all of our nominal accounts, which is drawing, revenue, and expenses, it should be zero. So if you still have balances in drawing, revenue, and expenses that are not zero, I think your closing entries are incorrect. So you need to review what you did. Okay, and lastly, the capital account should be updated with the amount equal to what is reported in the statement of changes in equity. To further illustrate step number 3, this is how we do it. So that is your T account for the capital. So as you can see, the 6 million there is the initial investment by the owner, and then 336,100 is your net income, and then the withdrawals by the owner is 30,000. Okay, so the ending balance of your capital is 6,306,100, which is equal to what we reported in the statement of changes in equity in the financial statements, which is also 6,306,100. So your capital account at the end of the accounting process after the closing procedures should be equal to how you did it in the statement of changes in equity. So your T account of capital should be equal to what your financial statements tells you. Only then you can say that you did your accounting process correctly as far as the closing process is concerned. Okay, and then lastly, we also have here the post-closing trial balance. So the post-closing trial balance is a trial balance prepared after all closing procedures. Since all nominal accounts have already been closed, the post-closing trial balance only includes assets, liabilities, and capital. So it's very clear to you that since drawing revenue and expenses are already closed, they have zero balances. So the post-closing trial balance would only include assets, liabilities, and capital. So here's how we do it. For landing on your travel services company, you just put the company name and then write post-closing trial balance, and we have there the end of the period, which is April 30, 2020. So here's how you do it. You just list all of the updated balances of your assets and contra assets, and then all of your updated balances of liabilities, and finally your capital. Okay, so as you can see, there is no drawing revenue and expenses anymore because they have zero balances. And what we only have in your post-closing trial balance are your real accounts. Okay. So after all these procedures, you need to make sure that the journal, your general journal, includes all of your normal journal entries. So all of the transactions have been recorded, and then your adjusting entries should also be journalized and posted. Your closing entries should also be journalized and posted. And then this is actually an optional step, and I will teach that to you in the next video, which is reversing entries. But if you choose not to do reversing entries, then you're done with the accounting process. Okay? And then the ledger balances are updated as to your real accounts, which are assets, liabilities, and capital. And then your drawing revenue and expenses should be zero. And then finally, your post-closing trial balance had been prepared, and it only includes your real accounts, which is your assets, liabilities, and capital. I hope you understand our lesson today, and our next lesson would be an optional step in the accounting process, which we call reversing entries. I hope you understand the lesson. Any questions, comments, or suggestions, you may put them down in the comment section below. Thank you, and have a great day.